If you want to become a profitable stock trader, all you have to do is spend a few minutes online searching for terms like plan your trade your plan, and maintain your losses to a minimal. Both of these phrases can be found very easily. These morsels may seem more like a distraction than actionable guidance to rookie traders who are just starting out. If you're just starting out in trading, you probably want to know how to make money as quickly as possible. Each of the aforementioned guidelines carries its own weight of significance, but when combined, their impacts become much more potent. Keeping them in mind might significantly boost the likelihood that you will be successful in the markets. Today we are going to talk about top 10 rules to achieve consistent profit. Before starting, make sure to like and subscribe to our YouTube channel for more future videos. Number 10. Keep trading in perspective. When trading, make sure you never lose sight of the overall picture. A losing deal should not come as a shock to us because it is inevitable in trading. A prosperous business is the end goal of each entrepreneur, and a successful trade is just one step along the way. It is important to remember that the total profits will determine the outcome. Emotions will have less of an impact on a trader's performance if they have come to terms with the fact that winning and losing are inevitable parts of the profession. That is not to imply that we shouldn't be excited about a transaction that has the potential to bring in a lot of money, but we need to keep in mind that there is always the possibility of a trade going against us. In order to maintain proper perspective while trading, it is critical to set goals that are attainable. It is expected that your company would provide a decent return within a reasonable amount of time. You are setting yourself up for disappointment if you anticipate being a multi-millionaire by Tuesday of this week. Number 9. Know when to stop trading. There are two factors to consider when deciding whether or not to continue trading: a poor trading plan and an ineffective trader. A trading plan that is ineffective displays losses that are far higher than those that were projected in previous testing. This does take place. There is a possibility that market conditions have shifted, or that volatility has decreased. Whatever the cause may be, the trading plan is plainly not producing the results that were anticipated. Maintain a level head and a business-like attitude. It is time to take a fresh look at the trading plan and either make some adjustments to it or start fresh with an entirely new trading plan. A trade plan that doesn't end up being successful is a problem that needs to be solved. It does not necessarily mean that the trading business will come to an end. If a trader creates a trading plan but is unable to stick to it, they are not a very effective trader. Stress from the outside, bad habits, and a lack of physical activity are all factors that might contribute to this issue. If a trader feels that they are not in their best trading condition, they should think about taking a break. The trader will be able to resume commercial operations once all of the obstacles and problems have been resolved. Number 8. Always use a stop loss. Traders use something called a stop loss to limit the amount of risk they are ready to take on with each individual deal. Traders can restrict their exposure during a trade by using a stop loss, which can either be a fixed monetary sum or a percentage of their whole position. Trading can be stressful, but if we use a stop loss, we can reduce some of that worry by ensuring that we will never lose more than a certain amount on any one trade. Even if it results in a profitable trade, trading without a stop loss is considered to be poor practice. Even though you have a losing trade because you exited with a stop loss, you are still practicing sound trading strategy as long as you acted in accordance with the rules outlined in your trading plan. It would be wonderful to get out of every trade with a profit, but that's just not going to happen. The application of a protective stop loss helps ensure that both potential losses and hazards are kept to a minimum. Number 7. Develop a methodology based on facts. It is well worth the work to craft a reliable trading approach, so don't rush the process. It's easy to get taken in by trade scams that promise profits so easy it's like printing money on the internet, and it can be tempting to believe them. However, when building a strategy for trading, one should base their decisions on facts rather than hopes or feelings. In general, traders who are not in a hurry to learn have an easier time sorting through all of the information that is available on the internet. Consider the following: if you wanted to switch careers, it is quite likely that you would have to attend a college or university for at least a year or two before you would be qualified to even seek for a job in the new sector. If you wanted to switch careers, this is something to think about. Number 6. Risk only what you can afford to lose. Make sure that all of the money in the trading account is actually expendable before you start using actual cash. This should be done before you start using real cash. In the event that it is not, the trader ought to continue saving up till it is. It is not a good idea to use money from a trading account to pay for things like college tuition for your children or the mortgage. Traders must never, under any circumstances, allow themselves to believe that they are merely borrowing money from their other important duties. The stress of losing money can be overwhelming. It is even more problematic if the money in question is one that never should have been put in danger to begin with. Number 5. Become a student of the markets. Consider it to be a form of ongoing education. Traders always need to keep their minds on the task of acquiring new knowledge. It is essential to keep in mind that gaining a complete comprehension of the markets and all of their complexities is a process that continues throughout one's entire life. Conducting in-depth study gives traders the ability to comprehend the data, such as the significance of the various economic reports. Traders can hone their senses and pick up on subtleties by focusing on the details and observing the market. The markets are sensitive to a wide range of factors, including global politics and news events, economic trends, and even the weather. The atmosphere of the market is very dynamic. When traders have a deeper understanding of both the historical and contemporary markets, they are better able to prepare for the future. Number 4. Protect your trading capital. It takes a significant amount of time and work to accumulate sufficient funds to finance a trading account. If you have to complete it twice, the challenge may become much more insurmountable. It is essential to keep in mind that preserving your trading capital is not the same thing as ensuring that you will never have a trade go against you. All traders have losing trades. To protect one's financial resources, one must avoid taking excessive gambles and do everything in one's power to ensure the continued success of one's trading enterprise. Number 3. Use technology to your advantage. The business of trading is highly competitive. It's probably safe to assume that the person on the other side of a trade is utilizing every piece of technology at their disposal to the fullest extent possible. Charting platforms provide traders with an almost limitless number of ways to examine and assess the market's activity. Backtesting an idea by utilizing past data helps to avoid making expensive mistakes. We are able to monitor trades from any location because we can get market information on our smartphones. Trading performance can be significantly improved with the use of technology that we typically take for granted, such as a connection to the internet operating at a fast speed. When it comes to trading, having fun and finding success may be as simple as keeping up with new products and putting technology to work for you. Number 2. Treat trading like a business. If you want to be successful in trading, you need to treat it like a business, whether you do it full or part-time, and not like a job or a hobby. If you treat it like a pastime, you won't put in the effort necessary to become proficient in it. If you're doing it for money, the lack of a consistent income might be very annoying. Trading is a business endeavor that can result in financial losses, stress, uncertainty, and additional expenses. As a trader, you are effectively the owner of a small business, and as such, you are required to conduct research and formulate strategies in order to realize the full potential of your enterprise. Number 1. Always use a trading plan. A trading plan is a written collection of rules that describes a trader's entrance, exit, and money management criteria for each buy. A trading plan is also known as a trading strategy. Because of advancements in technology, it is now simple to validate a trading strategy before putting actual money at risk. This method, which is often referred to as backtesting, gives you the opportunity to evaluate the viability of your trading strategy by applying it to past data. It is possible to put a plan into action in real trading when it has been devised and backtesting has demonstrated that it will provide favorable results. That's a wrap for today's video. What are your thoughts on our list? Let us know in the comments section below. And make sure to like and subscribe to our YouTube channel for more future videos.